Well, good evening, everybody. It's Sunday evening, the 13th of August. I'd like to go through a system that I introduced to you guys, a year ago, year and a half ago, something like that, 2 years ago, whatever it was, called TheStrat. At that time, I mentioned one of the better, probably one of the best educators in the field that I think is one of the best. She's a natural born teacher. Her name is Sarah Strat Sniper. Trade Sniper Sarah on Twitter, and of course YouTube, Sarah Strat Sniper. So she teaches a system. It was introduced by Rob Smith many years ago, and he's basically given this thing away for free. And it's a pure price action strategy. They've got all kinds of 2-bar and 3-bar, 2-bar, 3-bar, 4-bar setups, that sort of thing. What I look for, and I have found this to be true. This is a 10-minute chart. I found this to be true on. It works on all time frames, all charts, time frames, whatever. Okay. I like trading it on a delta volume chart, but you can also trade it on a time chart, as you can see right here. 10 minutes, because not everybody's got delta volume setups on their charts. I don't think Ninja does. I don't think they've got delta volume candles. But you can do it, and you basically use it on pretty much anything. So let's get into it. What it is you're looking for, and this is kind of my take for it. I look for what they call 1 bars. I look for 1 bars. I look for the small little bars, small bodies. The candles. The traditional strat stuff says you're looking at the entire candle, and what you're doing is you're breaking on, say for example, this is a 3, which is, like, some people call it some other bar, some people call it other things. It's a 3-bar, which basically means that it has broken both sides of the previous candle, right? And you trade in the direction of I guess you would trade in the direction of the wick. I would, because I look at the wicks and I look at a flat top and I'm going, this thing's probably gonna go up. It's green, it's going up. So a 2-bar, either an up or a down. 2-bar is one that breaks the top or the bottom, but not both, of a previous candle. So this would be a 3 because it's broken the top and the bottom of this one. This one's a 2. It didn't break the bottom, but it broke the top, right? Okay. Now, taking that into account, that's just the very basics. And a 1, of course, is just an inside bar that comes in. This is a 1 because the entire candle fits inside that previous candle, right? So it's relatively simple, relatively straightforward. Rob Smith introduced it. A guy named Hanma, who is basically came up with Japanese candlesticks, also talked about patterns and also talked about a system which is, it's very, very similar. And he came up with this, back in the 1700s. Rob Smith, I guess, I don't know if he discovered it or what, but he introduced it to the trading world. And it's caught on with a lot of people. A lot of people like it. A lot of people use it trading stock, various instruments. I haven't seen a whole lot of people trading it in futures, even though it does work. It works fine on futures. Okay, any particular market, you want to trade forex, you want to trade futures, you want to trade commodities, you want to trade stock, whatever you want to do, it works pretty well. Okay. Well, this is how it would work. Say for example, on here you got a break. Well, what happens is you're always looking at the previous candle, okay, and you're looking at maybe 2 candles back, right? Or if you're looking for just a 2-candle setup, it's pretty easy, okay. So you break in the strat, okay. Say for example you're looking for a trade, and you're in a trade, and And it's, market's going up, and you're looking for, say, for example, a short trade. Okay, you're looking for a trend exhaustion up here, and you're looking for a flip to the short. Well, there's an arrow right here. What happens? Look at this bar right here. It's a 2-up bar. It broke this guy. Broke the previous candle. Came up here, right? Wicked off, came down, came back up here, wicked off this guy just a little bit, and then came slamming back, and then came back down. The strat says you would put your, you always know your entry, your exits, and your targets beforehand, right? Now, there's different ways that people do different targets. For example, if you're trading multiple contracts on crude, okay, your stop would be above 83.16. Your entry is right there below 83.05, right? Where's your target? Okay, your target would be your basically the first, either right here, right here, right here. You're looking at a previous candle that is coming down that they'll, it can give you a decent amount of profit. Okay, you're not going to get 83.05. You're getting 5 ticks here. You're getting maybe 10 ticks here, right? If you're doing something a little more long term, what you would do is you would put, and I believe Sarah talks about this, you put your target at the bottom of the previous swing, right? So the bottom of the previous, the previous nice swing would be down here at 82.70, okay? So what you do is you put your target at 82.70. You're in at 83.05, 83.06, 83.70. You're looking at a nice, you're looking at a nice chunk of change. You're looking at $250 right there for basically doing nothing. Okay, so you're looking here. You could any of the bottom of any of these guys, right? The bottom of the swing is going to give you some decent profit, but you can look at any of these, right? Here, where did it start? Where'd the movement start to the upside? The upside movement pretty much started down here. You could say it started here, okay? And this was the bottom of this was the low, okay? But the farther your target's down, the longer you're gonna have to sit in this trade, okay? Now, what happened if you had your target at 82.58, you're getting in at 83.05, you're looking at a $400 move. But I just got $250 here. Do I really want to sit through all this in order to get that right there? Okay, which was 82.58. Okay, but that was, you're looking at, from 21.50. You're looking at from 21.50 way early in the morning. You're looking at. What's that, a 5-hour trade? So you're looking at sitting here for overnight for 5 hours. Okay, overnight. This guy you're looking at from 21.50 to 22.20. You're looking at a 30-minute trade as opposed to several hours. So whatever you guys want to do. It's I don't like sitting in a trade for hours and hours. Especially in commodities, the longer you sit in a trade, the more risk you're carrying, because you don't know if somebody from Saudi Arabia is going to come in and go, oh well, we're cutting back exports again. We're limiting to 500,000 barrels a day. Well, that's certainly going to shoot price up. Supply, the law of supply and demand kicks in, and you would go through the moon, and you wouldn't make any money on that trade. So I like to stay in a trade as short as possible. Okay. So this is the strat, and I'm going to show you guys some things. Number one, this is the traditional way to trade the strat. Number two, here's my way of trading the strat. Okay. I will either get in, and you can, this is, very, very easily automated. Okay. I get in at either that line right there. That's the 50% line. Okay. I'm going to get in at the 50% line right here. That's one way to do it. 83.10. I'm going to get it at the break of the body of the candle body not the entire candle itself. Okay, if you're breaking in there, you're getting in 83.04 versus getting in at the break of that, which would be 83.11. That's $70, $70 extra you can put in your pocket. And I haven't been able to find any significant differences between the break of the candle body and the break of the entire candle itself, body plus wick. Number two, I put my stop up here, same place. You know, I don't have a problem with the stops. My entries, and then my targets, you know, your targets could be, you know, the same place, you know. If you're using fibs, you can do a measured move. You can do all kinds of stuff to determine your targets. Prior swing is fine. The prior swing down here, and that's where you came down to here about 30 minutes later. So even over Globex, that's not a bad move. $250 for that. Okay. So you're trading here. You go down. Those are my entries, targets, and stops. One of the really, really nice things about the strat is when this candle closes, you know exactly what you're going to do. Okay? Exactly. If it breaks if it breaks either the body or it breaks the tail, I'm going short. If it breaks the head, I'm going long, right? And if I'm going long, here's my stop down here. If I'm going short, here's my stop up here, right? And then my targets would be previous swing, or in this particular case, wherever whatever the nice previous swing was at that particular point. So you're looking at a target maybe up here or a target up here, somewhere up in this area. As it turns out, you know, and it's a logical if-then thing. If it breaks here, you know, if it breaks down here, then I'm taking the short trade. If it breaks up here, I'm taking the long trade. Very, very easy, very, very simple, very rules-based, okay? I'm not going to get any broadening formations or you know, TTOs or any of that other stuff, okay? If you want to, you can look at Sarah's very, very excellent videos. I'm a big fan of Sarah because she knows how to teach. Unlike some of these other people, she has a gift. She has a gift for teaching, okay? So now I'm going to show you some things. Price action isn't enough. And here's why. Because you had an entry there, it didn't go anywhere. You had an entry there, didn't go anywhere. It broke, didn't go anywhere. This one went down, not very far. Certainly didn't go down here. This guy, there's an entry here, certainly didn't go up. I went up and then it, you know, hit this guy. And what you could make an argument that, you know, I'm going to go long until I get an opposing signal, right? So you're in at, you know, 82.76, 82.79, somewhere in here, okay? You're only coming up to here, and then when you get an opposing signal, if you get it there, 82.87, right? You're getting 10 ticks out of that. If you wait until down here, you're getting what, $40 out of that deal. It's $40-$50. So there's got to be a better edge. Okay, the strat gives you an edge, and it is really nice, but you got to have more. Okay, price action just sorry strat guys, the price action just isn't enough. Okay, you're looking for something else, not pure price action. Pure price action does not work because it works, but you know you're going to get chopped up in a bunch of this stuff. You know, you're going to have a losing trade there. You're going to have a losing trade there. What can I use on this chart that says it keeps me out of those trades? Well, there's actually several things you can use. Number one, you can use moving averages. You can use I like on a 10 or 15 minute chart. There's a line in the Ishimoku cloud called the Kijinsen line. I just call it KS right there. Okay, that helps me keep in. You know, helps me sort of kind of keep in the trade. It comes back down, it'll retest like right here, and then and then you can go south with it, that sort of thing. Retest, you can retest alongside. There's a wick. When you get a wick off that guy, then you would take that nice long trade right there. You take a good wick off the KS line right here, then you can take that nice short. And as you can see, it was very nice until you hit your target down here. Okay. You can use a moving average. Here is this is a 200 LRMA. I like the linear regression moving averages because it's relatively good depending on what chart you use at predicting price action and predicting price. So it's coming down, so you're already looking for a short. You're looking for it to come close to that line right here, and then you get a signal. There's your signal right there. There's a 50 smooth moving average up here. So whichever one of these gets hit first, you know, you're coming almost up to the moving average, and then you short it. You can use, by the way, you can also use VWAP. You can use VWAP extensions, whatever works for you on whatever chart you decide to trade on. There's another thing you can use is you can use the simple 50% line, basically half back line on a candle. See where that comes up? It's down here, right? Comes up and then comes down. You use the previous break. That's the half back of that particular candle. There's half back of the previous, right? You can use half back, or you can use order flow. And let me put order flow on here. All I'm going to show you is the volume point of control for each candle, right? And I think you're going to be amazed. Watch this. Okay, there's the VPOC. There's your volume point of control on your candle, okay? Now, you can see where it made the same type of movement here, makes a movement here, down, up, down, okay? There was a better short entry right there. It came up, and then it came down. I don't like the fact that this body was from 82.81 to 82.88. I don't like that. I'd much rather have 3, 4, 5 tick bodies in order to very clearly see what's going on, because that's not a very clear bar, right? At least on this time frame, it's not a very clear bar. On this one, it's great. Look at that. From 83.12, the body, from 83.12 to 83.15. That's a 3-tick candle body, right? So you know that what they're doing is they're fighting it up here. They ran into somebody that's selling right up here. And it could be that 200. But they're basically selling that. Could be a previous level or whatever. But the facts of the matter is they're selling it. So that nice small candle body, to me, that's a great entry, and I'll ride that entry to the moon and back, or to wherever and back, because of that, because it's a very, very good entry until I can get, if I get an opposing view, or if I just want to ride that thing down until I get the 3 o'clock, the London Open. Okay, here's the Asian Open. They sold it off. London Open, they bought it up. Okay, and that's pretty typical. If the Asians sell it, the Londons will buy it. If the Asians buy it, the London guys will sell it. That doesn't always work, but it's a pretty good rule of thumb. Okay? So we're looking at all these entries here. This is just, you can see how very, very small these entries are. You got one here at that line there. That gave you something, right? That gave you some, but it came back in your face, right? Because there's your entry right there at 82.78. It's a nice scalp move down for maybe 10 ticks. Yeah, there's a 10 tick move down. So it's going to come down, because when the VPOC is at the bottom of the candle, it goes up. When the VPOC is at the top of the candle, it goes down. Very simple and real easy. Top of the candle comes down. Bottom of the candle goes up. Top of the candle goes down. Bottom of the candle goes up. Top of the candle comes down. Fiddles around, keeps going back up here. Top of the candle comes down, fiddles around down here, right? Finally comes back up. But it's just nasty, choppy price action over here, okay? Now, dojis, you could look for dojis here, by the way, but those come up nicely. Now, why wouldn't you want to take this trade, for example? Well, when you put the VPOC on there, it's like clear as mud. It's like crystal clear instead of clear as mud, because you would take that, man, it's going to be a loser. Well, I mean, we know in hindsight, right? But when you're looking at that and that candle closes down here, there's your VPOC down at the bottom of the candle, right? Down at the bottom of the body of that candle, pretty close to the bottom of the candle. Why would you take a short there? It's going to go up. You know why? Because the VPOC's at the bottom of the candle. There's where your volume point of control is. At the bottom of the candle, it's coming down. Yeah, that's buyers. There you go. There's sellers. So volume point of control on each candle is very, very handy. For example, this one worked out relatively well. Why? Because I didn't have a signal up here, right? Because there was a couple of ones there. You could look at those multiple ones and say, yeah, it's coming down because here's VPOC. The second candle, VPOC's coming down. Okay, so you take the break and you ride it down. Yeah, that's a nice little chunk of change. You made some money. If you put that on, like, say, for example, a 15-minute candle or a 15-minute chart, you might not see that, right? And it might just be a 2-1, a 2 up, 1, and then a 2 down. So that would, that still would be a nice trade, but you're looking at the VPOC to confirm that trade. Up, down, and then it starts chopping, and it's just, there's nothing sharp about. There's sharp here, 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 but there's nothing else. There's, it just starts getting smaller and smaller and smaller, right? The distance between those volume points of control on those candles. So we're not doing anything, it's just chopping. Now we get down here. There's our move, the Asian Open. So you got to look at the time. Okay. You have to look at the timing. So you look at timing, look at order flow, and look at price action, and that's going to be your any sort of levels that you're like moving averages, whatever. Okay. So you're looking at that, and it works out pretty well. So you're holding this thing until the London Open. Right, here's your London Open. They drive it down. Here's a nice doji. This candle closes, but here is the VPOC way underneath that close. It's down in the wick of that candle, right? Well, what are we going to do? We're going to go up. So you flip it off your short, you buy it, right? Now here's one up here. You're having all these candle bodies up here, right? But what's volume point of control doing? Volume point of control is coming down. Right? And then you get this big 3 candle right there, which is probably an announcement of some sort. And then it comes back down. If you got shaken out of your trade, or if you exited your trade right here, because you're above the 50 SSMA, you're up here, right? You got that VPOC at the top of the candle, and you go, you know what, I'm out. So you take, you're out of that trade. You don't have any other signals up here. And look at those 1 candles. Look at those inside candles. That's a pretty darn big inside candle. That one there, that one there, like that one there, that one there. Do you really want to trade this stuff? Because it may come back in your face. Well, I'm looking for another. I'm going to look for another entry. So here we go. 5:30 in the morning. VPOC down here. As I come back up through. There's a school of thought that says when you hit the VPOC on the previous candle, when you go lower, then you sell it. If you go higher, then you go up. But this one's obviously peaked out and it's coming down. So it's pushing price action down. You could get into that, but you'd have to have your stop up here. And if you did, you'd get taken out. So you'd have your stop loss at like above 83.13. Well, look at that candle came up to 83.15. Unless if you had your stop up here, if you had a 10-tick stop or whatever, then it might be up here. So you might be safe, depending on where you put your stop. Comes down here, pins off what turns out to be today's low, or Friday's low. Pins off this sucker and just heads north, okay? You get these nice long candles here, and then everything comes to a screeching halt right at 82.23.25. I believe that was a level from Friday. I have to go look it up, but I believe that's a level from Friday. I had on my chart. So here we go. So you're going up. There's a nice buy trade. You're looking at 5:30. Not a traditional move time. What happened at Thursday at 5:30? Anything happen Thursday at 5:30? No. Thursday at 5:30, here we go. Thursday at 5:30, we're already in the move to the downside. We're already, here's that London open block. What happens is, London open block, they come up, they pierce it, right? Coming right out of that London open block, what happens? They sell it. Boom. And you just grab that gravy train and move on. Hold on to that sucker. Even if you want to do, say for example, one or two contracts here. Okay, so, and then it comes back up to the 50 SSMA and you take the sell. Or you can add to a contract there. You can add when it comes down through that 50 SSMA. You can kind of add one here when you get a short signal. But we didn't have, it didn't have exactly at 550 or 530. But we were selling pretty good. Okay. And you can see all these. You didn't get much of anything here, but if you'd gotten this short move, it's a nice move. Now, let's continue on with Friday. Okay. So we got this guy. We're coming up here. You didn't get any strat signals up here, but you did get an order flow signal to get out of your long trade. Now, and you possibly flip to the short. If you did, then here's where you would have gotten out. And then here's where the upside is. We come back into the 830, 930 block, which is bond market open, bond market auction is at 8:30. 8 o'clock, right there. You got a nice little doji there, right? There is a green, red, green. Okay, so we're going to go up, come down here, bounce down, then we get this, bounce back up, then we get this nonsense up here. But you're looking at you look at the candle bodies. If you ignore the wicks for the moment, look where all those candle bodies came through. And the wicks are getting smaller than this guy, than that wick right there. Wicks are getting smaller, so the buyers are getting, that's the glass gasp of the buyers at the moment. Gets in there, right? So you look at 83.43. Okay, cool. 83.43 comes down, pins rejects off this guy right here at 9:30 at the cash market open. And cash market open does affect commodities to some extent. Okay, you're looking at from like 9 o'clock in the morning. Look at that big bar at 9 o'clock. So you're getting into the trade and you're coming down here. Well, what do? Your KS line has turned green, so you're above that 200. So okay, I'm looking for longs. There was a nice long right there. The problem is you didn't have a signal because these bars are so big, right, on a 10-minute chart. If you go to a 5-minute chart, you might see something a little smaller, but or if you're trading like a Flex Renko or a Renko chart, you'll see this. Comes back up right here. That's a nice little short. Comes down, long short. It's very, very, very choppy until you get up to this 83.77. So if you were long from here, and you managed to hold on to this guy, that guy was like, scared a lot of people out of their positions, and you may or may not want to get out here. That's another thing of trading multiple contracts, is that you can get out here because everybody's trying to push up right here and it's not working. So there's some seller up here, right? Some seller up here that's pushing it down. Then you get a price rejection down here at that 830, 930, the end of that 830, 930 block, which just happens to be right here. Right, that little bitty, some people call that an order block or a breaker block or whatever. Okay, the scope of which is beyond the scope of this video. I'm not talking about order blocks or any of that stuff up here. But if you see something like that, see something like this, a little bitty resistance here, and then you're trending here, right? Little bitty candle trending here. You want to mark that area. I'm not gonna teach that, but it's just you're gonna mark that area, and I'll do an extend right there. Well, guess what? It came right back down to that block right there and went north. Okay. So that would be that'd be a good area, starting to mark off on your on your charts when you have a small area right here in between two big candles, continuation candles. I've seen several guys teach that, by the way. Here's another one. Big down candle, little bitty guy right here, big down candle. If you mark that, watch you mark that, hit extend drawing, boom, there you go. Oh, whoa, gee, wow, look at that. Came back up to that area, bounced off. So I have a guy, an institutional trader, that calls those order blocks. Anyway, so you can see where those are quite a bit handy. Okay, so here we go. We're going up to 83.77. Right up in here, you've got all these wicks off here. Last gasp of the buyers, right? There's a last gasp of the buyers right here, okay? If you didn't get out up here, or if you did, you just draw a line across there and just where you got out. You could get short here, okay? Or you could just wait. Just wait. Here you go. There's the retest of the high. Couldn't get up there, but look at that. Look at that. Look at that VPOC in that candle. You know something interesting? 83.71. It's exactly the same level as it was before. So you had sellers come in here. The buyers came in and tried to push it up. Sellers stepped in right there at the same level to buy it, to push it down. And then there's your 2 p.m. reversal block right there. So if you hadn't reversed, there's a good place to reverse. 83.67. You got a halfway block here. Price action pushes up, comes right back down, slams back down. And then you're at the end of the day. Right? So what's price action doing now? Okay. See, I missed a move. Oh well. So what happens is you're trading up into this, right? You got a strat signal here. You got that break of the 1, but what happens? VPOC is right up here. Candle VPOC is right there. It's like, no, I'm not trading into that. I'm not going along into that. Even if you were, if you did go along to that, and the VPOC was right, you might not have been there. Okay, so you're not there. So, but immediately as you see that up in that wick up there, you're saying not for me, and you can reverse out of that trade and come back down. Any of these moves, might be worth $100 or two, 100, 200 bucks. Now see this this nice gradual turn here? That's a nice gradual turn to the downside. I haven't seen that. I don't see that to the upside, but I do see that to the downside. See that nice little, see the tops of those candles? The tops of those candles kind of very gently come down. Now the market profile people have a name for this, and I can't remember what it is. And if somebody remembers, please put it in the comments. I don't remember. There's a difference between this here, right? And besides direction, and this here. Strong rejection, right? Here's a kind of a weak rejection, maybe a weak rejection to the upside. Weaker, you're getting a little bit of weaker rejection here. And then you get this strong, and there's another weak rejection. You get the strong rejection here. There's a pin there. There's a pin there. So pay attention to those things. So what's to our advantage? What do we want to be doing into Sunday? Okay. Here's your Keatingson line. It came all the way up to Keatingson line. I'm looking for it possibly to pin off of it, right? is starting to turn down. So I would be looking for another signal because I missed this one short. Okay, the key Jensen line is coming down. The 200, you're trading below that 200 LRMA. You're trading below the 50 SSMA. The 50 SSMA has turned down. Okay, so I would be looking for a trade anywhere in this area here for a short, unless things change for the night. Anyway, and then you could target. You could take, say for example, you took a short up here, and you're targeting this area down here, 82.90 to 82.60. No, it's $300. Anyway, I hope you guys have enjoyed this. See you later.